Ever thought about how the stock market operates? It might seem complex, but it's more accessible than you might think. This bustling global marketplace is where fortunes are made, dreams are realized, and sometimes where bubbles burst. The stock market, in its essence, is a hub for buying and selling shares of public companies. Historically, the concept of a stock market dates back to the 12th century, when French courtiers de change managed agricultural debts on behalf of banks. Fast forward to today, and we have a sophisticated network of exchanges around the globe, trading trillions of dollars daily. This vast, interconnected web of trades and transactions is vital for our global economy. It provides companies with capital to grow and innovate, while offering investors a piece of the profit pie. So the stock market is a place where buyers and sellers trade shares of public companies. But how does this trading actually take place? Now, imagine a bustling marketplace, only instead of fruits and vegetables, people are trading company stocks. This marketplace is known as the stock exchange. It's a venue where buyers and sellers come together to trade stocks, which are simply shares of ownership in a company. If you've ever heard of Wall Street, the New York Stock Exchange, or the NASDAQ, those are examples of stock exchanges. The process of buying and selling stocks may seem complex, but it's pretty straightforward once you understand the basics. It all starts with a decision. You decide you want to buy a stock. Maybe you believe in a company's mission, or you think its stock price is about to skyrocket. Whatever the reason, you've got your eye on a piece of the pie. But you can't just walk into the stock exchange and start trading. You'll need a broker. Brokers are professionals who are licensed to trade stocks on the exchange. They can be individuals or companies, and they act as the middleman between you and the marketplace. You tell your broker which stock you want to buy and how many shares you want. The broker then goes to the exchange and finds a seller. Once the seller agrees to your price, the broker finalizes the transaction. Congratulations, you're now a part owner of a company. The same process works in reverse when you want to sell a stock. You tell your broker to sell, they find a buyer, and once the buyer agrees to your price, the transaction is complete. Of course, all of this happens electronically and almost instantaneously these days. You can buy or sell stocks with the click of a button, thanks to online brokerage platforms. So when you buy a stock, you're buying a piece of a company. But why do companies sell stocks in the first place? Well, that's a question for the next scene. Stay tuned. Scene script. Companies go public for various reasons. Let's delve into why. Picture your favorite brand. You've probably seen its logo, used its products, or heard about its latest innovations. But did you ever stop to wonder how it became the giant it is today? One of the significant steps in a company's journey to becoming a household name is going public. The primary reason companies decide to go public is to raise capital. Imagine a business as a tree. To grow taller and stronger, it needs nutrients. In the business world, those nutrients are funds. Going public allows companies to sell shares to the public, raising vast amounts of money to fund expansion, research and development, or even to pay off debt. Going public also increases a company's visibility. Like a beacon in the dark, a public company attracts more attention. It gains credibility and prestige. This visibility can help the company attract more customers, partnerships, and talent. Finally, going public enables owners and early investors to cash out. They can sell their shares to the public, turning their years of hard work and investment into tangible wealth. However, going public is not a decision taken lightly. It comes with its own set of challenges, such as increased scrutiny, regulatory requirements, and pressure to deliver quarterly results. Going public provides companies with capital and visibility. But what does it mean for you, the investor? Investing in stocks can seem risky, but it also comes with potential benefits. Let's dive in and explore these benefits further. The first benefit that springs to mind is capital gains. Picture this. You buy a share of a company at $10. Over time, the company performs well, and the value of that share increases to $15. If you decide to sell your share at this point, you've made a capital gain of $5. This is the basic principle of buy low, sell high. Of course, the opposite can happen too. The company may not perform well and the value of your share could drop. That's why it's crucial to do your research before investing. Another potential benefit is receiving dividends. Some companies distribute a portion of their earnings back to their shareholders in the form of dividends. These payments are typically made on a regular basis, such as quarterly, semi-annually, or annually. It's like getting a little bonus just for owning a piece of the company. But remember, not all companies pay dividends. Those that do are usually well established and generate steady profits. Investing in stocks also provides an opportunity for diversification. You can spread your investments across different sectors, industries, and regions. This can help to reduce your risk. If one sector performs poorly, you may still have other investments that are performing well. Lastly, investing in stocks can help you keep pace with inflation. Over the long term, the stock market has historically outperformed other investments like bonds and savings accounts. This means that investing in stocks could help your money grow faster than the rate of inflation, preserving the purchasing power of your money. But let's not forget that investing in stocks comes with its own set of risks. The stock market can be volatile, with prices fluctuating on a daily basis. You could lose some, or even all, of your investment. So it's important to have a clear understanding of your risk tolerance and investment goals. Investing in stocks can be a way to grow your wealth over time, but how do you choose which stocks to invest in? Stay tuned to find out more. Choosing which stocks to invest in is not a game of eeny, meeny, miny, moe. It requires careful analysis and consideration. The world of stock analysis can be divided into two main camps: fundamental analysis and technical analysis. Let's start with fundamental analysis. This method involves diving deep into a company's financial health. Think of it as doing a health checkup for a company. You'll look at its earnings, revenue, cash flow, and other financial indicators, but it doesn't stop there. You also need to consider the company's industry position, its competitive landscape, and its future growth prospects. This method is like being a detective examining all the clues to make an informed investment decision. On the other hand, we have technical analysis. This method is all about patterns and trends. Instead of focusing on the company's health, technical analysts focus on the company's stock price and trading volume. Here, charts and graphs are your best friends. They help you identify trends and patterns in the stock's price movement over time. The key assumption here is that history tends to repeat itself. So if a stock's price has followed a certain pattern in the past, it's likely to do so in the future as well. Now, you might be wondering which method is better. Well, there's no definitive answer to that. Some investors swear by fundamental analysis, while others are die-hard fans of technical analysis. Often, a combination of both methods can provide a more holistic view of a stock's potential. But let's not forget, stock analysis isn't foolproof. There are always risks involved in investing. However, armed with solid analysis, you can mitigate these risks and increase your chances of success. With careful analysis, you can make educated decisions about which stocks to invest in. Remember, investing is not about quick wins, it's about long-term growth. So now you have a basic understanding of how the stock market works. We've journeyed through the foundations of the stock market, the intricacies of stock trading, and the reasons why companies decide to go public. We've also explored the benefits of investing in stocks and delved into the essentials of stock analysis. Each segment of this journey has been a stepping stone, building up your knowledge and confidence. But remember, this is just the beginning. The world of stock trading is vast and multifaceted, and there is always something new to learn. It's important to keep in mind that investing in the stock market is not just about making quick profits. It's about long-term growth and financial stability. So don't rush. Take your time to understand the markets, the companies, and the trends. Be patient and persistent. Not every investment will be a winner, but don't let that discourage you. Remember, even the most successful investors have had their share of losses. What sets them apart is their ability to learn from these experiences, adapt, and keep moving forward. As you continue your journey in the stock market, make learning a constant companion. Read, research, ask questions, and seek advice. Surround yourself with knowledge and let it guide your decisions. And with that, you are on your way to becoming a savvy investor. Remember, the key to successful investing is knowledge. So, keep learning, keep investing, and watch your wealth grow over time.